Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and The Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we interview Joel Littman and Rob Spivey of our corporate affiliate Altimetry.
And today Corey and I will talk about two famous billionaires, Charlie Munger and Elon Musk.
And remember, if you want to ask us a question or tell us what's on your mind, email us at feedback@investorhour.com.
That and more right now on the Stansberry Investor Hour. Two guys in the news. Charlie Munger, let's talk about him first. Of course, Charlie died on November the 28th at the age of 99. He would have turned 100 on January the 1st. And of course, he was the vice chairman of Berkshire Hathaway, Warren Buffett's longtime partner for decades and decades, and generally acknowledged as a very wise person. I know I'll miss him. Did you ever go to like a Wesco meeting or a Berkshire Hathaway meeting?
No, I did not have the pleasure of going to either one of those. But you told me separately that you were once in the room with Munger.
Well, just Munger and I and 1,000 other people.
Okay.
At a Wesco meeting. Yeah, the only time I've ever been in the room with Charlie Munger when, like Warren Buffett wasn't there and it wasn't 50,000 or whatever it is now, but it was a much smaller crowd. And I remember this was years ago. This was at least 10, maybe 15 years ago. It was before they bought Wesco, and all I remember was something that I thought was really dumb. And Munger was saying something like, we should carpet the country with solar panels and the economy could sure use the stimulus or something like that. And I thought, whoa, has this guy ever read an economics book? Is he this dumb? And so because I didn't really know a lot about him at that time. I know a bit about Warren Buffett, nothing about Charlie Munger. And I thought, oh God, am I going to sit here and listen to this? And I did. And I was glad that I did because he was funny and pretty smart too. You could tell he knew a lot about business. I don't think he probably ever talked for more than a minute when you couldn't immediately tell he was somebody pretty special. So, but my initial impression was really not great.
That's funny. Yeah, that's funny. Obviously he's like probably, will go down as one of the most well-known and successful investors of all time, if for nothing else, his association with Warren Buffett. But obviously he had his own story before he met Buffett too. Although his story really goes back to, almost entirely connected with Warren Buffett from his first job. Charlie Munger's first job was working for Warren Buffett's grandfather during the Great Depression for like 20 cents an hour. And so they've been linked since then in one way or another. So it's really fascinating. I probably, like most people, I became aware of Munger from watching the Berkshire Hathaway shareholder meetings and him being on stage next to Buffett during the Q&A portion. And, Buffett, goes on these long-winded answers and very detailed and will bring up all kinds of different things. And then, Munger will often say, I have nothing to add, or he'll come up with some other one-liner that, is funny and short and blunt and would sometimes make Buffett uncomfortable. And so that was always fun to see, just like these two guys, how they must have like bantered in their office in Nebraska together and come up with things to buy or not buy and those sorts of things.
Right.
So
yeah, I think Munger actually remained based in Los Angeles the whole time, if I'm not mistaken.
Right. Oh yes. Yeah.
I don't think they ever shared an office, but yeah, they were obviously they spent a lot of time
on the phone,
and stuff, and yeah. And I wouldn't, who wouldn't mind being a fly on that wall, right? I am impressed by, all the same stuff everybody else is, and I had to reread the Harvard commencement speech. It's actually reprinted in a book called Seeking Wisdom from Darwin to Munger by a guy named Peter Bevelin, who Munger had a lot of good things to say about. And it was June 13th, 1986. And I never knew this before. I hadn't read the speech before. I'd only seen excerpts. But he got the idea from Johnny Carson, who had given a Harvard commencement speech. And the whole speech is about prescriptions for guaranteed misery in life. And Carson said, I don't know, I can't make you happy, but I can tell you how to be miserable because I have a lot of experience with it. And he said, ingesting chemicals in an effort to alter mood or perception, envy, and resentment. Those three things were apparently Carson's focus. And then
Don't do drugs.
Munger added, yeah, do drugs and alcohol trying to alter your mood. And Munger added, be unreliable, learn everything you possibly can from your own personal experience, minimizing what you learn from others. Go down and stay down when you get your first, second, or third severe reverse in life. And what is the other one? Yeah, don't learn how to avoid bad stuff. Most people tell you how to do good stuff, but they won't tell you, hey, avoid all the bad stuff, basically.
Yeah, those are.
And
Yeah, go ahead, sir.
okay. Oh, I was just saying those are that's his prescription for guaranteed misery. Carson's three things plus his four, and it's a great way to think about things, what not to do. I've often, or certainly occasionally, I would say several times in the past several years, written about the via negativa, the negative way. That is, the way Nassim Taleb stated it was, he said, the learning of life is about what to avoid, and that is basically what Munger's speech was about. Really smart.
Yeah, it's interesting you bring that up because that's one of the things. There's also this great biography that probably a lot of people are already familiar with, Poor Charlie's Almanac, about Munger, which our friend and colleague Whitney Tilson actually is in and contributed to, and his caricature is among the contributors in the front of there. And that's one thing Whitney pointed out. Obviously he knows Munger and Buffett better than most people, and that's one of the things he talked about was that Munger would one of his big points was how to avoid calamities, and it's because he experienced them. He was married twice, lost his first child, died when he was 9 from leukemia, which had no cure or treatment at the time. He went blind in one eye from a botched cataract surgery, Munger did,
Mm,
and just had, some various heartbreaks in his life and,
yep.
persevered. And well, I think he also part of his early story, and I'm actually planning on going and reading through Poor Charlie's Almanac again the next couple of days because I'm getting more interested in how like the super wealthy or successful, got their starts. Because it's easy to talk about wisdom once you're, you know, God bless him, but he's
Yeah.
90 years old. He's got a lot of wisdom behind him, and it's a little easier to talk about wisdom that way. But when he was like 20 or 30, he was a lawyer. Charlie Munger went to Harvard
Mhm.
Law School. It was just like a lawyer working for local businesses, and then at some point he realized he changed his fees from getting paid like hourly to actually trying to get a stake in the companies that he was working for, an equity stake, which I think is really
Wow.
interesting. And that kind of launched him into investing eventually with like a real estate firm, and and then I think ultimately partnering with Buffett. So
Mhm.
just the value
Interesting.
of equity, having an equity stake in a business, like he was practically doing it. That's how he got his start, and then basically he was doing that until a week
Right.
ago. So yeah, it's those lessons from the start. But obviously he had problems along the way too. So whenever somebody like this passes away, it's like it's a valuable thing to like actually look at their story and take what you can from it, especially a guy like him.
Yeah, and I also saw a thing where he was talking about his 3 investments, apparently, which is like, the overwhelming majority of his net worth in 3 investments: Berkshire Hathaway, Costco, and a fund manager named Lee Lu that he liked to talk about at Berkshire Hathaway meetings. Uh, but yeah, and both he and Buffett are always talking about, focusing and knowing what you're doing. If you don't know what you're doing, you can diversify. You know, they're really down on diversification,
Right.
and I don't know. I'm kind of impressed by that actually. Three investments: Berkshire, Costco, and Lu. And I would imagine, I don't know, but I would imagine Berkshire is like the biggest by far. But you could argue, well, that's one investment, but it's 200 companies.
Right.
So
Yeah.
is he not undiversified? Well, maybe he is a little more diversified than all that. But they did spend decades and decades and decades, the two of them, focused solely on that, which, that doesn't surprise me. I mean, look at all the billionaires that you can think of. The least focused one is like the richest guy in the world, though, Musk. We should probably talk about Musk.
Yes. Also in the news for geez, just about
Yeah,
completely opposite reasons, as we're talking
yeah.
glowingly about Charlie Munger.
I know. Yeah. So it's interesting. Musk was alleged to have made some anti-Semitic remarks, but so far from what I can gather, um, I mean, no less than Bill Ackman. I think Bill Ackman's second wife, his current wife, is like Israeli, and he's Jewish himself. So he came out on Twitter today, and he was, or today or yesterday, and he was defending Musk, and he said no, he wasn't really making anti-Semitic remarks, and him owning Twitter was a great thing. He's a great advocate for free speech, and what Disney is doing is wrong, et cetera, et cetera. And our own previous guest, and let's face it, our boss, yours and my boss, Porter Stansberry, retweeted that and agreed with it and said, let's all boycott these companies that are refusing to advertise on X because they don't like Elon Musk and claim that he's an anti-Semitic when he's really not. But that got plenty of attention. And then what got the most attention, of course, is his interview with Andrew Ross Sorkin. Sorkin, not the quickest of cats at the best of times. I can criticize him all day long because I think he's too fawning with all these rich people that he seems to worship, rather than just kind of interviewing them. But in this interview, Elon addressed the folks who won't advertise on Twitter by saying, "Go F yourself," twice. And he wanted to make sure that he got his point across. He said, "Is that clear? I hope so. Hi, Bob," meaning Bob Iger, CEO of Disney, which I thought was a great little quip.
And he called it blackmail
Yeah.
by these advertisers pulling, which of
Yeah.
anything, that's where I took the most umbrage with.
Mhm.
I mean, it's not blackmail. They're making a business. They're making a decision,
No.
and he's upset about it. But
Right. Yeah, it is definitely not blackmail. It's just I would call it a really woke, hasty, ill-considered kind of a decision. But I don't know. Maybe I just like Musk's mojo too much. Anybody who tells Disney and others to go F yourself, I just like I'm automatically on their side. I can't help myself. I can't help myself. I
right, it's
just
like it reminds me like a few weeks ago we were talking about hot mic moments with when Jerome Powell was like,
yes.
"Close the effing door." To
Yeah,
the climate protesters who allegedly,
that's right.
were walking on stage with them. And this is like, yeah, you always
Yeah.
like to, you. Oh, I think most people like to see somebody who's like unvarnished and just do that. What Musk did on
Yep.
stage. Everybody would probably like to say that to somebody, and he can, you know, because he's the richest, guy in the world, I think, or first or second. I don't know
Yeah,
at
he
this
is
point.
still. Yep.
Twitter is obviously losing money hand over fist, but he can still afford to do these things. He doesn't, obviously he's, well, I don't know. I don't know what's going on in his head, but he's obviously not afraid of losing these advertisers. It doesn't seem to bother him with that comment.
No, he said, he was really incensed. As you said, he made that comment about being blackmailed. He said, You're not going to blackmail me with money. Go f yourself." But he said, right, very plainly, this will kill the company. And I thought, are you when you say go F yourself, are you really talking to the people who lent you $12 billion to buy this thing last year? Are you really talking to your lenders and your investors? By the way, of which Bill Ackman was one, when they took it private, and his foundation apparently. And I just thought, who are you really talking to here? And what is your point? Because It was a very odd moment, and I encourage people to look it up online. It was just a very odd moment when he said, "Oh, no, this is gonna bankrupt the company. Yeah, this will kill the company." Like, and there was an enthusiasm behind it. There was an energy behind it that I found very odd. I would have expected him to say, "Yeah, this could kill the company, and I'm really, really bummed about it." No, he said, "Oh no, this will kill the company. Yep, this will bankrupt it." Like, do you want that to happen for some reason? I mean, I just I found his demeanor very strange.
Yeah, I've seen to that point, I saw some speculation that maybe he wants the company to fail at this point so he could get a tax write-off from it.
Yeah.
Um, which maybe there's something to that. I mean, this isn't yes, and or maybe if it does fail completely, like this would be a great
Mhm,
narrative reason to say why it failed, because these companies don't
mhm.
support free speech or aren't in line with just having different opinions out there and that sort of thing, which might be true. But um, this would be maybe a decent reason for to attribute his failure at Twitter/X to. I mean, because this is not. It might ultimately bankrupt the company, but it's been headed this direction for a year since he took it over. Um, they've kind of gutted the staff and lost all kind of you know he's been losing advertisers for a while, and the person who he hired as CEO, who was brought on in to bring on advertisers, she's got a pretty tough job right now. I don't know how much longer she's going to be around, or
Yeah.
she always, she's like cleaning up, the big guys' problems out there in public. But yeah, I don't know what's going to happen with Twitter. It was in trouble before he took over, and it's from a business perspective, and it's probably worse now. So who knows? It's still a great community form, I think, given all its problems still.
It
It's still a
is.
great place to
Yeah.
find ideas. Like we use it. I use it every day.
Yeah, I can't stay away from it.
Right. So hope it doesn't go away completely because it's a useful tool for me. But um, I think a lot of people. But there is just
Yeah.
this
I mean,
this this fatigue over it, I think, too, from a lot of people.
there is, like, we've gotten several guests from me contacting them on Twitter and saying, "Hey, you wanna be a guest?" And they said, "Yeah, sure." And, next thing you know, we're interviewing them, so it's been really valuable to us, and it's valuable to me every day because I'm just old now, so I rant and rave like an old person, and I have to do that every day or else I just don't feel right. Um, so, yeah, I'm with you. I hope it doesn't go away, and him buying it, I thought he was very earnest about free speech when he was acquiring the thing.
Yeah, I think he is too. I think he is too. Yeah.
There was speculation that he didn't really want to go through with the transaction, he tried to get out of it and all this stuff, he was just kind of it was bluster, but, throwing billions of dollars around is a really weird way to to sort of, exercise your bluster. I don't know how else to put it. I I sort of doubt that he, spent $44 billion buying Twitter just because he was having a hissy fit. I think he really does believe in free speech, and I have to say, this community notes function that, kind of fact checks things, it does a good job, and it doesn't appear to be nearly anywhere near as biased as it used to be. I mean, before they were just, anything that was anti-status quo was just it was taken down or whatever, or fact checked or whatever they used to I forget what they used to do. But now it's different and it's better. People say it's terrible, but I disagree. My experience of it it hasn't even really changed.
Mhm.
So I don't know what anybody's talking about when they say Twitter's no good anymore. It doesn't make any sense to me.
Yeah, from a product perspective, it seems to have all the same same qualities and
Yeah.
problems that it had before. Um,
Mhm.
and I'm with you. Like once, I don't know why he ultimately decided to buy Twitter. I suspect he wanted to make it better ultimately. And
Mhm.
then once he commits $44 billion, I'm sure he's not trying to run it into the ground. Um, I don't think that would be the goal. Um, I'm just
No.
curious, like now at this point, based on what you've seen, like how much money they're losing, if he's just kind of, I don't know, given up, or to some degree. I don't know.
I I I find that hard to believe. I find it hard to believe that a guy who has spent his whole life working his tail off to build and build and build and build could behave differently with Twitter. I don't think it works that way. I don't think human nature is that plastic, and you can't go over here and try to build, multiple huge businesses, from like PayPal, Tesla, all of it. Um, the Boring Company, SpaceX, you know, the companies that are doing some pretty incredible things. Um, and you can't go from building that to, oh, well, I'm going to go play games with Twitter. I'm going to go invest $44 billion and play silly games with Twitter. I don't believe it. Um, so, having said that, I'm glad he owns it. I'm glad he's in charge, and I hope he works it all out, and I hope the platform stays around, and I hope he tells more people to go F themselves.
For the record, before anybody writes in and tells me I'm hating on Elon Musk, I don't necessarily think that he's deliberately, uh, you know, crashing the company either. And you know, and he's doing what he wants and what he feels is right, which is all you can really ask from a person.
Yep, and he's been able to he's kind of unusual because I think the way that, a lot of billionaires, they kind of virtue signal, right? They get super rich, and then they want their name on a building, on a hospital or college campus, right? That's sort of the typical thing, or a foundation or something. And but Musk, I don't know if he has a foundation or a building with his name on it, I don't care. Um, I think he's done something different. He sees these problems, these great problems, and then he takes on a massive project to try to solve it. One of the things, though, as much as I admire the guy, like he said, I've probably done more to save the planet than anybody. I mean, because of course he's got Tesla, right? It's this electric car company, and I just thought, well, you know, I don't know if he really believes that or if it's a marketing line, because we know that folks like that are capable of, weaving it, you know, crazy marketing stories. And I thought, well, it's interesting that I admire the guy so much, because I think that is really dumb. I think all this environmental, climate stuff related to electric cars and all this stuff is really insanely dumb. And 50 years or 100 years from now, we'll all look back and say, "Oh my God, those people were so stupid to believe that one of the essential elements for life on Earth was poison, CO2." And the whole thing, it's an insane narrative with no evidence whatsoever. And other than that, I think Tesla's pretty cool. I mean, have you driven a Tesla? The thing pushes you back in the seat. It's an awesome drive. Absolutely awesome. I drove a Tesla Model S. It was amazing.
So what I'm hearing is Elon Musk and Charlie Munger actually have something in common for you.
I
Going
know.
back to the solar
They're both a
panels,
little,
yeah.
yeah.
Going back
They're
to
both a
Charlie
little batty
Munger's
on the climate
solar
stuff.
panel bullishness years ago, and Musk
Yeah,
doing great things for the world and saving us all. So
exactly.
with the,
I thank you for bringing that
with
around.
the
Yeah,
eccentric billionaires, you take the good and you take the not so good,
exactly.
and you
Exactly.
hope that the good outweighs the not so good at some level.
Right. Which I think it does in both of their cases by a long shot. But let's move on. Let's talk with our guests. Two of them. We got a twofer today. The folks from Altimetry, Joel Littman and his good right hand, Rob Spivey from Altimetry, an affiliate of us, of Stansberry Research, under the MarketWise banner. And I love talking with these guys, and not just because they're sort of in agreement with me about the market for the next couple of years. I love talking with them because they're really smart. They have a totally different approach to things. And rather than me saying another word about it, let's talk with Joel Littman and Rob Spivey. Let's do it right now. The man who predicted everything from the rise of inflation to the death of the 60/40 portfolio is stepping forward with the clearest and boldest prediction of his 4-decade career. It all boils down to a single stock, and it has nothing whatsoever to do with artificial intelligence. Former Goldman Sachs trader Dr. David Eifrig believes anybody confused by the current market conditions needs to hear his story immediately. Many of America's best-known investors already bought shares, including Paul Tudor Jones, New York Mets owner Steve Cohen, and Jim Simons, the man the Wall Street Journal named the world's best investor. People in the financial world know Doc Eifrig as the man who went on 3 separate winning streaks of over 100 winning trades in a row. But today, he's zeroing in on just one company and wants to hand you its name and ticker symbol at no cost. In fact, he believes every American should own this company, and soon. To get the full story free of charge, simply go to docprediction2023.com. Again, that's docprediction2023.com. Okay, Joel, Rob, welcome back to the show. Nice to see you both again.
Dan, pleasure as always.
Hi, Dan. Thanks for having us, man.
You bet. Hey, I should have you guys on once a day as long as you're bearish like me. I'm gonna. I need all the backup I can get at this point because stocks keep going up and I keep looking wrong. So maybe just for our listeners' benefit.
Well, triple tops.
Yeah. you see a triple top? Is that what's going on?
A triple top. It always looks that way.
Yeah.
Well, yeah. I mean, so 4,800 S&P December of 2021, and then July,
right.
And then now.
Right. So, and everybody gets super excited every time, and then whammo. So 2024 is going to be like wham. People aren't expecting it right now. The market says, "Hey, we're happy," right? So 2024 is going to be probably pretty ugly, in your opinion.
It's funny, you look at the narrative out there, and you look at all the data, but then you look at what people are focusing on. It is this classic setup. People always say the market inflicts the maximum amount of pain to the maximum amount of people, and it certainly feels that way now because soft landing narrative is definitely fully engaged right now. And it's funny, we were talking to one of our institutional investor clients about a month ago, and it was funny. We were walking through everything that we look at from our macro perspective that has us concerned about the credit world. And he kept on going, he goes, well, okay, that makes sense. But so the market will look through that recession, right? And so I should just be buying early stage companies now. And we were like, well, actually what happens is the market falls and then you should buy those early stage companies. So that was an amusing conversation. And that's definitely the hope and prayer that people are working on right now, Dan.
Right. But Joel, hope and prayer is not a strategy, is it?
Not at all. Yeah. I mean, this rolling recession nonsense that, and it's another big bank on Wall Street just said, well, autos have already had the recession, so things are good now. Or like, are you high? Have you not seen, they're like, well, consumer prices are down because they said, so it used to be cars were selling for above MSRP a year ago. Now they're selling for below MSRP. You have the highest delinquencies in subprime autos since 1994. That's 30 years, right? And literally, you have them saying, oh, yeah, that means it's over. We're like, no, it doesn't mean it's over. It means it hasn't even gotten started yet, right? In terms of a true recession autos. And autos is now the third biggest consumer debt area. So this idea that, it's rolling recessions, and so that's why, it'll be a soft landing, or what you're seeing is early signals of things getting really, really bad, which they are.
Yeah, and it's interesting to me how, like macro folks who I follow on Twitter, X, formerly Twitter, and other places, and who I just know personally and interact with, they're not there, like at all, really. Which, it's a bit of a head scratcher for me. My bearishness relates mostly to cycles in security market valuations and the consequences of those cycles. And none of that seems to be none of this concern seems to be anywhere. And I mean, so far, those guys are all on the right side of the trade, but I don't know. It never, what we've been through never ends well. What we've been through in the past few years, and really in the past, you could call it 15 years or so, basically from 2009 bottom to now, just, it tends to have a certain set of consequences, and they tend to be really bad. And I don't know.
Yeah,
No.
I think if you look, it's funny because I was talking to somebody else recently, and we were actually saying, they said, what is the thing that has you and has us at Altimetry most scared for the rest of 2023? It's like, what was a big surprise that could happen? I was like, the big surprise is all of the looming issues that, Dan, you're talking about, and that we talk about all the time in terms of the credit environment and how it's setting up for economic growth and everything else to be struggled. So the issue is, there doesn't actually have to be a catalyst for that to actually come into the forefront for people for possibly until early 2024. So the scariest thing for me, right, for our readers and for anybody who I talk to, is that everybody just keeps on getting lulled in the sense of confidence of like, oh, look, the Fed has been tightening interest rates for a year and a half and we haven't had a recession. Well, if we're not going to have a recession, if we haven't had one yet, we're probably not going to have a recession. So everything is fine. And if you look, that's what's happening underneath the surface, to your point, Dan. It's like everything's building up, but until you actually see that catalyst, everybody gets lulled in the sense of confidence. And that's why, we're concerned in the way that we are.
Okay, so you guys have indulged me because I've done something I always want to do on interviews, and the guest usually doesn't let me get away with it, which is just to jump into the deep end. I just want to jump in the deep end and see where your head's at. But for our listeners' sake, maybe we'll just back up a little, take it a little easy here, and ask, just remind our listener, they've heard you talk about this, but it's okay. A little repetition is a good thing. How did you come to your bearish thesis at the present time?
Well, it's a combination of quality of the earnings, valuation, the multiple on the earnings, and then the momentum and which way it's headed, right? You can think of it as, from the earnings quality, earnings revisions continually go down. The fact that every continent, whether you're talking about Germany pulling down the EU, China pulling down Asia and the world, Latin America, where you got multiple countries in deep recession and hyperinflation, multiple countries in Latin America, you put all this stuff together, there's no way you could say that we've got any kind of growth. So the earnings growth is limited. You've got what will be eventually successful for the U.S., for U.S. corporations, which is a designing and a re-engineering the entire global supply chain, non-China, non-Russia, or very little, right, China, very little Russia, compared to the way it used to be. That's going to take time to work out. So you've got companies spending in CapEx like crazy, U.S. companies, which is going to bring down free cash flow. You're going to see earnings, fall off for a while. This is not going to, start revising back upward. And then you take valuations of something like a 24 times earning multiple, which you can find historically when you have deflationary periods. So if you're actually looking at valuation multiples over time, I have no issue with a 24 times multiple 2 years ago, 5 years ago, 8 years ago, when you have a deflationary environment. But when you have the kind of inflation that we've had and we think is going to stick around for a while, 24 times multiples in a no earnings growth scenario being revised down with this level of inflation is just crazy that they'll stay at these levels. This is very different. I mean, Dan, we've been bulls for, my goodness, since 2009. And in 2020 at the bottom in March, April, May, we were bulls also then because these were not the same signals. But now that we have all these signals lining up, of course, we have to sit back and go, this is different. The signals are telling us to be different. And that's across quality, across valuation, across growth, and, throw in some overly ambitious sentiment right now that's driving up this triple top that we're seeing in the S&P. You have everything setting up for what's going to be another 2008. Everything is set up there.
Yeah, and the one thing that, to add to Joel, is the other thing that has us, that's really caused us to flip the switch in really August 2020 at first, was starting to see all the setup that we're seeing in the credit worlds. The bedrock of what we do and think about from long-term cycles, right on top of that earnings cycle stuff that Joel talked about in terms of how uniform accounting lets us see the true numbers, is really understand how credit expansion and credit contraction really is the lifeblood of economic cycles. And what we saw basically starting late last year and really got concerned about this year was how first availability of credit started getting sucked out of the system. And you really can't have economic growth without having availability of credit, right? The way that people actually spend money to either buy stuff or to make stuff is by taking out credit to do that stuff. At first, that was okay because of the fact that, quite frankly, we had such liquid balance sheets for US consumers and US corporates that even with tight credit, they kind of could shrug and say whatever. But in the last year, we finally started to see the actual fundamental credit picture start to wear out, where we're seeing consumers and corporates now are actually running out of that piggy bank that they had. And so the fact that they can't get access to credit actually starts to matter. And that's why we've actually been really concerned if you layer that on top of everything Joel just said.
Yeah, I caught a Bloomberg article about consumers running out of cash this morning, which, for a long time the narrative was, well, they've got so much more excess cash than even pre-pandemic. But, according to Bloomberg, nope, no longer true. And, and I think it's probably right. A lot of people who are in the macro world anyway look at the consumer as a very important leading signal.
I remember people saying the same thing about the strength of the consumer is going to carry all the other problems of the market. I remember saying that in October 2007. I can remember it distinctly. In October 2007, people were looking at consumer signals like, oh, but consumer's strong and we're going to have a really strong retail season and we're going to have a good Christmas and you can already see the signs for it. And to some extent, they were right, meaning at that moment. And then what happened in 2008? So I would say this looks so much like October 2007 right now, particularly with the rally that we're seeing in the market, that this is that last hurrah before all the real fundamentals kick in and people say, oh, wait a second, I've got to get out.
Because so many people forget, right, that the whole entire thing was in 2007, we had a top in June, May or June, right? And then we had the quant crash. And then we rallied all the way back up into October, November. And it's not similar to another period that we often talk about, which is, the late 1940s, it looks like too. So this is a pattern that's repeating 100% to Joel's point.
Yeah, guys, this is Corey. I mean, you're talking about 2007, 2008. Me and Dan talked about this a couple weeks ago. Like the GDP numbers that people are talking about now literally are the same exact numbers before 2008, to your point, Joel. And talking about the strong consumer, is it just that people just get lulled into this sense of complacency? And like Robbie, you were talking about, some people that you were talking to, just they think that everything will be okay because the recession hasn't come yet. But then that's exactly when it comes, right? I mean, we've seen throughout cycles in history.
So we've been talking here, people talk about $3,000 gold forever, and we're lucky if it'll hold 2,000 right now. We've been hearing about the bond markets, which is a bloodbath. Anybody that was buying, and what are you going to do? Buy bonds at now, and just because you think 4% is a good rate, right? Despite what may come. And so bonds have been a bad place. Precious metals, and especially gold, has been not a great place. You start looking around, venture capital, private equity, particularly with all the real estate that's buried in private equity. So I think people are like, oh, but at least the stock market's going up. So let me just throw my money in there. I don't think it's a well thought out position. I think I kind of got nowhere else to go, right? Because I don't want to just sit in cash with inflation where it is. But I think we're going to find that cash may end up being one of the best places to be coming into the next year.
That's not sexy, man. So I want to go back to something that Joel said a moment ago. Joel, you mentioned inflation and, the need for lots of new industrial plant. And we've heard this theme before with other guests. Right now, everyone's partying like inflation has been. It's a has-been topic. It's past. Don't worry about it. You disagree?
Well, anyone going to a grocery store would disagree. Anyone going to the gas pump would disagree. When we're talking about, I'll say, Main Street Americans, I don't think they're looking at, okay, so if you're going to buy a $2,000 laptop, yes, $2,000 laptop gets you a lot of computing power. No question, it's a lot cheaper than it was 2 years ago. If you're talking about wireless phones, all right, telecom usage, that's probably cheaper than it was. So it depends what your basket is. But if you're talking about basic living needs, right? I don't know, or even just, let's say, semi-luxury. Have you been to a restaurant in New York City? Any restaurant in New York City or Boston or Miami or DC or anywhere on the West Coast, anytime in the last year, you do not believe that inflation is subsiding, right? You see, if anything, and even when you look at wage increases that still continue, which tend to peak, by the way, wage increases just ahead of a recession for the last, 10 recessions or so. One of the things we do is we run cognitive analysis on Powell, and we actually listen to what he's worried about. He is not worried about employment. He is emotionally wedded to hitting a 2% number. And I don't think he thinks whatever basket he's using that he's anywhere near 2%, which means he has to keep rates up for a while, which means that continues to help add to the recession, adds to tight money, higher interest rates for a longer period of time than people think.
And we think, too, to add to that is when you look at what's going on and everything that we're excited about the supply chain supercycle and about the rebuilding of supply chains, really making US at the center and not China, is the conversation that we think isn't really being had enough is there's going to need to be structurally higher inflation if that happens, right? We're not talking about, 8 to 10 to 12 to 15, but 2% isn't a realistic goal if we're going to be rebuilding supply chains in places that don't have very, very low costs in terms of people and everything else. I mean, just the fundamental structure of investing, stuff has a gravity, right? And so when you actually invest in stuff, you then need to get more stuff along with it. And so all of that buying of stuff actually does create inflation. The way that services inflation doesn't necessarily really actually have a lasting impact, but stuff inflation, when we actually buy stuff, and this is what we're going to be doing when we build new factories, new fabs, new infrastructure throughout the United States and Mexico and Canada and all of our friendlies, it's going to lead to higher structural inflation, which is part of the reason why I think Powell, to Joel's point, it has that visceral reaction that we can see in the earnings call analysis and the analysis of his Fed minutes and presentations. We can see it, and we think that's part of the reason why.
Well, we know they're kind of, I would say, irrational about targets. They establish these targets seemingly rather arbitrarily, in my opinion. They seem arbitrary to me, I'll just say. And then they slavishly stick to them. And of course, what nobody realizes is that you can't hit them. There's no hitting it. You go past and you see it over here and then you see it over there, but it's never right in front. You're never hitting it. It's never a bullseye. So, hitting 2%, the trip from, just call it 3 down to 2 is a lot harder than people think. And to get there, to hit that target, to maintain that slavish devotion to it, it's going to hurt. They're going to have to hurt the economy to get there, I think, anyway.
And when you hear the supply chain discussions across CEOs, we listen to earnings calls in ways that, with technologically, we listen to earnings calls. We actually listen to earnings calls of so many calls. And they're all talking about supply chain resiliency, supply chain protection, supply chain, whatever. And every time you hear that, you have to think stuff is going to get more expensive. Every time you hear they talk about supply chain resiliency, it means things are going to get more expensive. That means you're going to have these rising prices, and that is going to contribute to these inflation issues that Powell is trying to fight. And I don't know that he's got all the tools in the box to fight it. Meaning, he's doing what he thinks is right, which is going to lead to certain consequences, in terms of recession and tight money policy, whatever else. But I don't think he's going to solve the issue. The only solution is going to take years, and over years we will have a better supply chain. It won't be dependent on certain markets that I think people are worried about, like China. But it's going to take a while to get those efficiency back in that system, and that means things are going to cost more. It's not going to be fixed next year by any means.
Right. It makes me kind of get excited about the prospect of screening for, cash gushing, industrial, companies making highly engineered materials and parts and machinery and things like that. It makes me want to just start building that list right now.
It's a fun time, right? I mean, to your point, Dan, it is a fun time. I mean, it's been a long time since we've been able to really talk about something that's not, let's talk about investing in this SaaS company that's going to have cash flows that might come out in 10 years, right? And now we're finally at a point where we can say, hey, look, we can invest in actual, real, near-term cash flow companies. One of the things that when you talk about what happened in 2022 and really what's kind of happened in almost an accordion factor in 2023 in terms of where people have put money in stocks and taken it out and put money, right? Because it's all about fund flows when you try to understand how the stock market moves. The biggest thing that happened last year was the crash that we saw for all of those tech companies that had gotten so inflated was all this idea of, because at zero interest rates, guess what? $1 of earnings in 15 years that might happen is worth as much to you as $1 of earnings today that we actually know is here. But all of a sudden, at a 5% interest rate, it matters if that dollar is here in 15 years, because the fact that the 15-year dollar, that dollar of cash flows in 15 years is worth a little bit less. And so to your point, I mean, this is why we've been so excited looking at, near-term cash flow companies, cash-rich companies in so many different areas, farm and everything else, but why we think that industrials are such a fun place to be able to look now, because you finally have the opportunity to take advantage of it.
Oh man, you're speaking my language with that cash flow thing, the time value of money. I've written a little bit about that. I try to stay away from it because it tends to be a dryish topic, But yeah, exactly that. I love every bit of it.
Well, that's part of the point we were opening up with, Dan, which is that I have no problem with the 24 times multiple in earnings if we've got zero inflation or deflation, because those cash flows are worth so much more today. But when you have an ongoing environment that's going to remain more like today than it was 5, 6, 7 years ago with that 0% number, how can you think that a 24 times multiple today isn't a lot more expensive than a 24 times multiple in a different inflation and interest rate context? It's not the same number. The 24 times number today is a lot more expensive than that same multiple 5, 6 years ago.
Right. And so, correct me if I'm wrong, rather than buy that very sort of low yielding, unattractive, overpriced equity, you're much more interested in buying the credits, the debts of those companies, those higher quality companies, because now they're yielding 5, 6, 7, 8%. And that's a lot more fun than, buying for 24 times, isn't it?
Exactly. Yeah. I mean, this comes to the whole entire idea that, ever since we started our business, since Joel and I founded it in 2009, we've always looked across the whole entire capital structure, where we've always actually analyzed bonds and equities. But for literally 13 years, we never talked to clients about bonds, because we said, hey, look, literally, this is not the environment to buy bonds in. But exactly to your point, when you're in an environment where all of a sudden inflation has pushed interest rates up to a level where now actually I can make money, right, buying bonds. And actually, because of concerns that we're having pop up in terms of where interest rates are going and inflation is going, sometimes we can make equity-like returns in bonds. That's why it's been, why we launched Credit Cash Flow Investor, which we launched 2 months ago, was we said, hey, look, this is finally the time to tell our clients you need to be in bonds, because it actually makes economic sense to be, which is, it hasn't been a thing that we've been able to say for 15 years, right? Because when you're making 0% on bonds, why are you wasting your money tying it up in bonds? Put it in equities. But now it actually makes sense to have a rational balance of how you put money in equities and in bonds, because there's the opportunity there.
I'm sold. Sign me up. I totally agree with you. And
yeah, it shouldn't imply that we're suggesting a 50-50 bond equity portfolio. What we're actually saying is that security selection is necessary, all right, more than ever. We wouldn't be buying the S&P. We'd be buying very specific stocks in very specific pockets that are going to do well from the supply chain super cycle and from the re-engineering of the world's manufacturing, industrial. And from a bond standpoint, we wouldn't just be buying bonds by any stretch of the measure, just buy a bond fund, because that could be a very, very bad decision. However, security selection specific corporate bonds, where you can get realistically 10 to 25% yields. You're not going to get doubles or triples like you could get in the stock market, but we can realistically get 10 to 25% yields, but you're not going to get that in a bond fund. You've got to get that in specific bonds. And I think that's where strategically we've really moved to, is that security selection is king right now, because you can't just buy outright bond funds or equity funds without having this level of diligence.
So some of my compatriots here at Stansberry and I are interested in business development companies, just for similar reasons. Where do you guys stand on those?
Rob?
Yeah, great question, Dan, because the fact that we wrote a whole entire series of pieces earlier this year that was all around what, if you remember back in 2007, 2008, everybody was talking about the vampire squid, right? That was taking over Wall Street, was Goldman. And the point that we were making recently is actually the real vampire squid isn't Goldman. It's Blackstone, because Blackstone has its hand in everything. And those BDCs are a perfect example of it. You look at these BDC RICs, and it's really terrifying what they have done, because of the fact that they're making loans to high risk, high yield companies. And yet the way that they mark to market these loans, they basically don't acknowledge any of their losses. They don't have to do anything that a bank does. Right? This is the whole entire issue with private credit in general. Is everybody's? I swear, you can't walk through Wall Street right now without, if you swing a dead cat, you're going to hit somebody who's working in the world of private credit right now. And that should have you terrified. But the BDC RICs are the epicenter of it, because what they are doing is effectively saying, hey, where banks won't lend, we'll lend. But we don't actually have to have any of the quality control rules that banks do. We don't have to report our non-performing loans. We don't have to basically write down our loans. We basically just hope and pray, and we extend. And so you're just building up this mass of people who have credit from people who don't actually know how to underwrite. And the BDC RICs, well, they've got phenomenal yields now. That's why we're terrified of all of them. There's some of them that are better and worse, like any structure. Some of them have actually learned how to do things really well, but a lot of the ones that are the highest yielding ones, those are the ones that are some of the scariest parts of the credit world out there. And where we've told people, the yield's there, but be a little careful, because you might not be happy with how that yield looks in 2 years.
Fair enough. Absolutely. Personally, I've recommended one BDC, and I think I might be done. And I was a little surprised to find some of my colleagues, like one of them he said, I am irresponsibly long BDCs in my private account. And I thought, wow, I didn't expect that, because, we all know what can happen inside of a thing like that, speaking of 2008, when people were marking stuff to fantasies, right? All right. So we like security selection. This is why having you guys on here is like a feel-good fest, because you're bottom up, fundamentally oriented, macro aware investors. And, so it's just kind of a mutual admiration society. But it's not the kind of show where I'd have somebody on that I didn't like anyway. So I guess that's not a big deal. But you like bonds. You do like stocks. Also, like me, you don't say, go sell all your stocks. And that is where you are right now. There is a pretty popular narrative right now. The Fed will definitely cut interest rates next year. So before we talk about anything else, do you care about that narrative? Do you care about whether it's right or wrong?
We think that the idea that the Fed is going to cut next year is right, but this is the classic example that I think we were talking about earlier, the idea of, people wanting to look past the bad news that's going to happen and the pain that's going to inflict to them to think about the positivity. Yeah, the Fed's going to cut interest rates next year. And you know why? Because we're going to be in a recession, right? When Joel talked about the idea that Powell has this visceral emotional reaction to inflation, he doesn't care about unemployment. Well, there's a reason why. And it's because the fact that unemployment has been incredibly strong for so long that he basically is looking, he goes, I can keep on keeping interest rates as high as I want for as long as I want until that unemployment number rises. And I'm not seeing it take off, so I'm going to go to war with inflation. And all that he's doing, right, is effectively saying there's this idea in finance, and actually I think in physics, so I won't pretend that I understand physics that well, of this idea of area under the curve. Right. In terms of, it's not about how high or how low things go. It's about how much area is under the curve, in terms of, if you have high interest rates for really, really long, you build up this pain and this pressure that builds up underneath the curve. And then all of a sudden it has to blow off. And so all of a sudden what's going to happen is, because of the fact that they are basically saying, we are watching unemployment rates and saying unemployment rates are the decision for when we're going to actually cut rates. That's under the hood what they're effectively saying by saying, we're not worried about unemployment rates right now. The only reason why unemployment rates rise, right, is because of a recession. Right? There's a reason why the SAM rule is the only actual economic indicator that has predicted every single recession for the last umpteen recessions. Those the SAM rule is basically that when unemployment moves 50 basis points above its 1 year cycle low, 6-month average, when that moves up above that, that is consistently every single time a sign you're in a recession. Well, we're already 2/3 of the way there. And in terms of where we are, and if you look at the trend, it's going up. But that's why the Fed's going to cut interest rates next year. And yeah, we are actually, I won't say we're concerned or not concerned. The Fed is reacting to the economy there. It's not going to be the one to save the economy. It's only going to cut rates because the bad news is out there and the recession's there.
Yeah, I believe that last point is really too horribly lost on too many people.
Yeah, but Powell really cares about two things and two things only. He doesn't care about the stock market. He's not looking at the bond market, right? He cares about, do people have full employment, which he has, and then do I keep inflation at that 2% number, which he's emotionally tied to? And as long as unemployment stays low, he'll beat on that 2% inflation number with his only tools he has, which are basically, interest rate policy until and economy and everything else. Who cares? Because if it's a little bit, who cares what the economy is? If people are employed and there's low inflation, then I've done my job, right? Let everyone else worry about the other things.
That's the mandate. So he's like, good, I did the mandate. I did my job. I can go home and have a beer now. Sure. So I just do want to mention that Joel and our other guest, our other colleague, Mark Chaikin, have recorded a presentation that is along these lines, but it focuses on what stocks you ought to buy with, I believe, one name in particular. And you can go there. You can participate in this. You can see what they have to say. If you go to stockwarning2024.com, stockwarning2024.com, and that'll be a nice presentation of Joel Littman, Mark Chaikin talking about, I'm sure Joel will talk about the reasons why, he's bearish, same as here, and Mark will weigh in as well. And, they both agree that you shouldn't run out and sell all your stocks, and they'll have an idea or two for you. Stockwarning2024.com. So it's time for our final question. And you guys have answered this before, but I'll just repeat it for our listeners' sake. And we'll start with Joel, if we could. If you could leave our listener with a single thought today, what might that be, Joel?
Yeah, I have to mention, what a terrible thing the passing of Charlie Munger is at 99 years old, and what they've done and what Charlie Munger's done for the world. I think the wit and wisdom of Charlie Munger. Thankfully I was able to get a couple of signed books from Charlie before he passed away, and I would say the wisdom in those books about investing are fantastic. Long term, the fundamentals still play out. Long term, right? The U.S. fundamentals will still be the best place to be, and I'll say that all day long. That doesn't mean that if you're going to need the money in the next 2 years, you can just willy-nilly buy stocks and say, I'll just close my eyes. So if you've got a Charlie Munger length of time, yes, you could let and ride things out of the storm if you're talking about a 10-year money you won't need for 10 years, right? Ultimately, U.S. stock market will be a fantastic place. But if you need the money in the next 5 years, you can't just be buying bond funds or stock funds across the market. It is a very, very, very bad strategy if you need that money inside of the next 5 years.
Okay. How about you, Rob? One thought for our listener, if you could just one.
Absolutely. I think it's that the next 12 to 18 months are going to require you to be tactical. They are not an environment where you're going to be able to just buy the market and close your eyes, just like Joel said. And that's why you need the tools to be able to figure out what are the stocks or the bonds you're going to want to own, because it's not going to be the kind of environment where everything goes up. It's not going to be the 2010s. It's not going to be the second half of 2020 into 2021. This is a different environment that we need to be more cautious in.
Amen. Listen, it's always a pleasure to talk with you guys. I love having you on the show, and not just because we agree this time. And I'm looking forward to doing so again real soon.
Dan, a pleasure as always, man.
Thank you, Dan. It's great. Thank you, sir.
The Fed wants you to believe they've got inflation under control, but I believe we've only seen the beginning of a devastating new crisis. And if you don't prepare now, you could see your savings evaporate as inflation and interest rates soar even higher over the next 2 years. It all traces back to a golden thread that ties together the biggest financial calamities in America's history. But it seems the entire financial world is falling into this very same denial trap that led to massive devastation the last time this crisis played out. If you know your history, you know there will be winners and losers, and now is when you decide which one you'll be. I've spelled it all out in an urgent new report. Go to www.bankrun2023.com to get your free copy. I'll also show you how to get my complete playbook for navigating this crisis, including the 3 critical steps to take immediately. Again, that's www.bankrun2023.com for your free copy of my new report. Well, it's always good to talk with Joel Littman and Rob Spivey of Altimetry. I hope you embrace the basic message. I really do, because I do think it's going to be a difficult, for me, I think it's going to be a difficult couple of years. Rob was talking about 12 to 18 months. but we'll see. I won't claim to know or to be able to predict that. But Corey, do you have a takeaway or an impression that you wish to share?
Yes. I've, I always like listening to Joel and Rob, partially because, they're dealing with clients as well. And so they get a lot of anecdotal kind of evidence and that sort of thing about what real investors are actually thinking in the market on Wall Street. My big takeaway, though, is, everybody wants kind of a black and white answer for what's going to come, in anything really. But let's talk about recession in 2024 or what's going to happen in 2024. But, I think you hear from them, you got to be tactical, I think was the word Rob used, and selective, and also consider your timeline. If you have a long, huge, Charlie Munger like timeline, you might not be as concerned with the next year or 2 years as somebody who has their retirement nest egg built up already and doesn't want to see it drop 30%. So I think that those are always important things to keep in mind that always get overlooked in our business. When people just want to hear what's going to happen next. What should I do? Like you got to think through it a little bit. It's not going to harm you to think through these things, even if everything goes well.
Yeah, that's a great point. By all means, simplify things if you can, but a lot of times with investing, you can't, and trying to creates more problems than it solves. And it's best to say, well, I don't know, and I'll base my decision on that, what I don't know and the risk that I see rather than the trend that I think is guaranteed to happen, which never is, right? That's a good point. I'm glad you said that. We need to make that point repeatedly in our business, don't we?
Yeah, the truth is people don't want to hear that, I don't think. So, but it's
No, they don't.
that's what'll make you money in the long run, I think.
Yep. They want us to know everything, and if we say I don't know, they don't see. Some people don't see the value in telling the truth that way. But I think Rob and Joel are two people who really they know right where to focus. They know exactly what to tell investors, and some of it involves I don't know, but they're always about where to position yourself now, and that's about as well as you can do. You can't predict what's going to happen in 12 or 18 months, but you can sure look at all the signs and signals today as they are and say, there's a risk of this. And they're not running out and saying, everybody sell everything, it's going to be horrible. They're just saying, hey, cash will be a good place to be. Be very picky about stocks, be very picky about bonds. And bonds are more attractive than they were. We weren't telling our clients about them, and now we are. And that message right there, that much, that's hugely valuable, I think.
Yes, and they have tools for doing that too. I assume Joel is going to talk about this in his event with Mark Chaikin. They're at Altimetry has this uniform accounting methods that cut out a lot of the noise and things that Wall Street and corporations can hide in their financials, and really pick the true strong companies. So I assume they're going to be talking about that as well.
Yeah, I'd bet on it. Yep. They don't just have an interesting view. The view comes from having these incredible tools and years of experience. Mark Chaikin's got decades of experience, and so do Joel and Rob. So that stockwarning2024.com is where you can go if you want to hear that information as well. And I would go there. You learn so much, even if if all you do is listen to the presentation, they'll give you a deal. For listening to the presentation, they'll give you some kind of a deal on their services. But if all you do is listen to that and take notes, you'll learn a lot and you'll come away potentially a better investor. So stockwarning2024.com. All right. Well, that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com, please. And also, do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, until next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.